When completing my certification as a Roth Conversions specialist, I realized more than ever how nuanced and complex this decision is. It's not as straightforward, one way or the other, as many YouTube gurus try to make it out to be. To help you better understand that and see what I'm talking about, we're going to jump behind the screen with an actual real-life case study that I just went through. Now, part of the problem with most of the financial planning software that are attempting to answer this Roth conversion question is that they are not accounting for all of the variables, or at least as many of the variables as they could. There are more than you might think. So although I can't expect a perfect model, I want to get as close as possible so I can get a more accurate understanding of the actual impact that this very important decision is going to have on my client's financial future and on the financial impact to their heirs. Now, for us, for our firm, there are 4 different software that we use when working through this Roth conversion question for a client. The one that we use to get us our final figures, the most accurate information, the information that is accounting for the most variables, is also the least popular software of the 4. It took me a long time to find it. I had to sift through a lot of the stuff that's out there, and I have yet to meet another advisor who's using it. But first, let's look behind the scenes of just one of those mainstream software programs that we use when we're initially solving for this problem. This one helps me and clients get a better idea of the impact a Roth conversion can have. All right, so let's jump behind the screens of this particular software here. And there are a lot of other financial planning considerations that we're working through here, but again, we're just talking about the Roth conversion. So let's look at the various ways that we could structure a Roth conversion to compare the difference between the tax rate that their client's gonna end up paying over their lifetime, the average tax rate, the total taxes they pay, the total net income they receive, and then the total net legacy that would be left to go to their heirs should they do these various Roth conversions, implement these various Roth conversion strategies. Now, we don't want the tax tail to wag the planning dog. The biggest consideration for them is their net legacy. What's going to leave their heirs the most and what's going to put them in the best position in the long run. So let's scroll through these options here and find the strategy that makes the most sense, that's going to give them the highest. So these 2 strategies seem like they're giving them the highest net legacy and also coming out the most beneficial in these other areas as well. So we'll just go ahead and look at this 32% bracket here just for the sake of illustration. But you can see the difference between not doing a conversion and doing a conversion. Your net legacy goes up by $370,000. But again, we'll look at this other software that I'm talking about to get a more fine-tuned idea of what's going to happen in all of these areas. But what I do want to look at with a client is the idea of how much you're paying in taxes over time. Are you paying more on the front end so that you can pay less later on, or the other way around? But probably the most impactful consideration is, what is it going to do to your individual accounts? So this is a breakdown of the Roth conversions over each individual year. So we're looking at, on average, around $400,000 a year over these 6 or so years. And then you can see this purple drop off because at this point, all of it's been converted over. But let's look at what it does to their portfolios. This yellow here is your tax-free account balance. This is something that if you implemented a traditional strategy of just pulling out of your accounts, you never do any Roth conversions, that doesn't exist for this client. They don't have Roth IRAs yet. So they have $0 in that tax-free account balance. So if they have a large expense later in life, they have to pull it out of one of these other accounts. And if they need to pull it out of a taxable balance, one of those that's the pre-tax dollars, then 100% of it is going to come out as taxable income. But if they've implemented one of these strategies where they've done some Roth conversions, and so now they have a tax-free account, they have much more flexibility later on in retirement. They don't have to do all of it. You don't have to convert all of it, but having some in a tax-free account can be nice. And then when it passes to your heirs, the taxes are already taken care of as well. And we'll get into that a little bit more detail with that next software. So with all that, you can visually see there are potential advantages to implementing a Roth conversion strategy. But if we really want to help the client, we need to dive deeper. I see a lot of advisors, too many advisors, that just look at a software like that or one of the several others that we use or that are out there and conclude Roth conversion makes sense, let's move forward. But when we look at one that accounts for more variables, you'll see that it's actually significant, the difference it can make long term. Because when we account for those additional variables, it's not actually quite as attractive as this software and the other two make it seem. Before we dive into this other software with the more accurate insights, I should note that there are several other tax planning considerations that we will be working on over the years with this particular couple. For example, the amount they ultimately decide to contribute to nonprofit organizations through qualified charitable distributions and through charitable legacy planning using pre-tax funds. All of that is going to impact ultimately what they put towards Roth conversions. So there's other things that they would be doing that will factor into this. We would work yearly with their CPA or with the CPA that we partner with in order to fine-tune those numbers for the client. But for simplicity's sake, and to highlight the impact of this one decision, we're going to leave out those variables for now. I just didn't want you to think that we're overlooking those. All right, so let's dive into that more detailed Roth conversion analysis. This software is specifically designed for Roth conversions. It's less robust in other areas, but just real quick, you can look at the summary of their assets. So these 3 accounts are pre-tax accounts, and then the next 3 are non-qualified accounts. It's that simple, that straightforward. They have a few other things going on, but these are the accounts that we're working with this part of their financial plan. And so we can come over to their taxes over here, and we can look at the year-by-year analysis with these straightforward assumptions, what their taxes are going to be at these various years. You can look through this tax column and see the total tax implications and just kind of get an idea of what they're looking at as RMDs start to kick in and how they're going to have a heightened tax bill later in life, which again is fine. That's not necessarily a reason to do this, but I want, for the sake of comparison, you can see that at here, what they're looking at now if they don't implement any Roth conversions. But now let's look at this scenario where, what if they do those Roth conversions that we were looking at up to that 32% tax bracket? So now you can see on this chart, the dark blue is switched over to a light blue because they're converting some of it over to a Roth IRA. And so I took that 400,000 number from the last software we looked at, and I plugged it into where we are doing $400,000 Roth conversions, getting money out of these pre-tax accounts where every dollar that comes out is going to look like ordinary income tax, and into an account that's totally tax-free, a Roth IRA, where they're not going to have to pay taxes anymore. They pay the taxes now, and then they're done. So we can look at that tax summary, and you can see the heightened taxes on the front end where they're paying in the 100,000 range because they're pushing up against that 32% tax bracket, which means that a large chunk of that conversion is coming out in the 24% tax bracket. So if we're converting 400,000, then simple math would put that around 100,000. You can see that here reflected, but then you can see significantly lower taxes later in life, right? So that's just one aspect of it. That's one side of it. But let's look at the analysis here. If we look at what it's going to do for this client's surviving spouse, and then for this client's heirs, right? That's what they want for their money, is to make sure that it's working its hardest, it's in the best position to take care of the surviving spouse, and then also to take care of the heirs, right? To leave something behind. So the starting balance in each of these is just referring to the value that's left when each of these events happen. So when the client dies, how much is left in the accounts for the rest of the planning for the surviving spouse? And then after that, how much is left in the accounts when the spouse dies for the heirs, right? So that's the starting balance. It's a little bit of a weird way to put it, but that's one of the primary numbers that we're gonna look at here, because you'll see with the conversion here, that's the net legacy number. Really, it would be this one down here after the spouse dies, is the net legacy number that last software was looking at. And it said there was going to be about $370,000 more if you did the conversion, but this one is showing $760,000 less. Now, we could get into a conversation of what additional variables this one is accounting for that one is not, that made such a difference. But yeah, it makes a difference, and this one is accounting for more. And I think it's from the analysis research that we've done, I think this one is providing us with the best, most accurate analysis of these decisions. So the client here is actually ending with less money. Their plan is ending with less money. Now you can look at all these other considerations where they had less of an IRMA penalty over their lifetime because they did the Roth conversions. They had way less of a burden and stress from RMDs, right? There's 4 million in required minimum distributions that came out without the Roth conversion. But with the conversion, it was $73,000. Significant difference, almost $4 million difference between those two. And the penalty, if you mess up on an RMD, is significant. So having that stress off their plate, that's not worth nothing. It's worth something. And then you look at taxes, they will have paid a little bit less in taxes over here. By the time he died, they actually had still paid more in taxes. But over time, you can see that it plays out. They've paid less in taxes. But now let's look at what happens to their heirs. So their children, they have 2 children, both of them are successful. They're in a relatively high tax bracket. Now, as laws stand today, they would inherit the IRA funds, the pre-tax funds, and they would have 10 years to get the money out of that IRA. The government wants its money, right? Now, if the primary client here had already triggered their RMDs, then the heirs would have to follow that RMD schedule, but still in year 10 would have to get all the money out. If they had died before the RMDs started, then the heirs could pull it out however they wanted. But again, by year 10, they would have to pull it all out. And so this is considering that. It's allowing for the growth of this starting balance at the time that the second spouse dies. It's allowing it to grow. And then it's considering the taxes that would still need to be paid on the part that hasn't been taxed yet. So we can look at the details here and look at the breakdown of these different accounts that the heirs are receiving. And, you can put yourself in this situation or put yourself in the situation where your heirs are receiving this. A lot of the money's been pulled out of these pre-tax accounts. So you can see the rollover IRA here is the only one that's left and been moved into non-qualified accounts because of the required minimum distributions. So you can see $8.2 million in this non-qualified account. But in the rollover IRA account, there's still $2 million that the heirs are inheriting. Whereas when you look at the with conversion scenario, there's next to nothing in the rollover IRA, and there's $6 million in a tax-free account. So consider the difference in if you were inheriting. I mean, you're going to appreciate it regardless, but if you have this large tax burden because you're inheriting $1 million or $2 million, and you're going to have to worry about the tax implications of pulling those funds out over the next 10 years, or if you inherit $3 to $6 million, depending on the number of children you have, from this tax-free account, there's a big difference. So yeah, we'll save this information and see what the impact is long-term for the heirs. But now you know what we're looking at. So in the end, the net legacy balance after the 10 years, right? Again, that other software wasn't accounting for that. After those 10 years, accounting for the taxes that they have to pay is $138,000 difference, right? So they're still left with $138,000 less after all taxes are gone. Now they've even paid less in taxes, but because of the effect it has on growth when you pull that out early and all these other considerations, they actually ended up with less money. Now, that doesn't mean it's not worth it. So like I said, there's a lot of other reasons to do this. Having those tax-free accounts can remove a lot of stress, can remove some variables. If you think the tax rates are going to change, right? You can remove that variable, you can take it off the table. But it is good to be aware and have an honest idea of what you're actually dealing with here, the decision you're actually making. It's not a $400,000 swing like that first software made it look like. There are different reasons you're making this decision. But let's keep diving in. Let's fine tune this. Let's say the client here was worried that he was going to pass away shortly. He said he's 68 now. He said he might pass away at 74. So what does it look like if he were to pass away at 74? He's passing away earlier here. What does that do to this Roth conversion analysis? So same Roth conversion assumptions. We're still moving over 400,000 a year. It's the exact same as what we did. But you can look here after she passes away. So he passed away at 74, and when she passes away at 90, this is a little bit closer, a little bit less bad as far as what is being passed to the heirs. But that difference made up the difference down here. So yeah, in this realistic scenario where what he thinks is more likely to happen, he's going to pass away earlier, it actually is more advantageous for the heirs and for the spouse if they do more Roth conversions on the front end. And part of that is because of the widow's penalty, where she moves from a married filing jointly tax filing status to a single filer status, which penalizes her significantly. So they call that the widow's penalty. It's not great, but because they've done some Roth conversions, she's going to experience that less. So that addresses that consideration. We'll go back to a normal, a longer life expectancy here, planning for the rest of it. But let's look at the Roth conversion where we convert, instead of the $400,000 a year, we convert about $300,000 a year. This is up to roughly the 24% tax bracket. But when looking at the other software, it was right around $300,000 a year that we were converting. So that's what we're going to be looking at here and drawing that comparison. And you'll see that it's a little bit better than the 32% tax bracket that we looked at, and a little bit more favorable difference here for what's left to the heirs. It was about 180,000 negative, and now it's 66,000. So you can see a little bit more favorable there. But what if we play around with this? What if we stretch it out and we say we're just going to convert their rollover IRA here? So remember, this rollover IRA has about 1.5 million in it. What if you just convert that and we do $100,000 a year over the rest of your life? How does that compare? Just as a baseline as you're going through this consideration. And that ended up being quite a bit better, where you can see that after the spouse passes away, it's a little bit it's quite a bit closer, a few $100,000 closer. They still were able to avoid a lot of these tax considerations, or at least minimize the effects of them. But the effects to the heirs were now positive, and decently so. About $200,000 positive swing for the heirs. And that was from doing $100,000 conversion pretty much every year of their retirement. Obviously, like I said, there's a lot more nuance here, and they're not going to do that exactly each year. That's going to depend on their long-term legacy charitable contributions that we talked about, the qualified charitable distributions over the years. There's other things that are playing into this, and they may want to do larger upfront contributions for the Roth conversions to help, if he thinks he's going to pass away early, to help with that widow's penalty, and then do smaller conversions after that. These are different things that we're going to consider, but this gives this particular couple that we were working with a better understanding of the impact that this can have on their long-term planning future for themselves and for their heirs. Clearly, there's a lot of nuance to this Roth conversion decision, and it's an ongoing process once you decide to do it. It's something you want an advisor to be able to help you with year in and year out. An advisor who's working with you long-term, who you trust to guide you like this throughout your retirement. If you have specific questions about your situation, there's a link at the top of the description for you to get on my calendar. Or if you have a simple question, feel free to ask it in the comments. I wish you all the best. Take care.